Hello everyone, how's it going? In this video, we will talk about Mullen Automotive, trading under the ticker symbol MULN. As the market remains volatile and active over the past few weeks, as well as the future outlook looking as uncertain as ever, we will go through the latest fundamentals, the price actions, and my analysis, as well as recommendation to hopefully help you make better decisions. As always, if you appreciate what I do, please consider to drop a like, subscribe to my channel, and check out the links in the description. Before we begin this video though, I'd like to make a quick disclaimer, clarifying what this video is about and what it isn't. What will be presented in the video are going to be my opinions and interpretations on what things or how things are and how they will probably be. They're not investment advice, they're just watched for entertainment purposes. They may be able to help you make more educated decisions. They certainly shouldn't be the only thing that you base the decision making off. Most of my analysis is done in the immediate past or just a few days before the uploading. And sometimes the price action may no longer reflect what you currently see on the chart by the time it is uploaded. Nevertheless, it's very useful still because it'll help you analyze the momentum, the overall price action momentum of the stock. Also, the analysis will try to cover the stock as comprehensively as possible, and it's going to talk about more factors than just the latest news or the price actions. For instance, we're going to talk about the company's financials, stock market trends, the long-term perspectives, and shareholders' behaviors. These are going to affect the timing, the quantity, and the actual decision. Since most viewers are watching my videos for the first time, it matters for them to consider all these factors whenever they click on any of my videos. So with all that being said, let's begin with today's topic. Mullen operates in the EV manufacturing, distribution, and marketing areas. It acts as a holding company for several brands and companies they may purchase along the way. The company first began operating in 2014 as a successor to Koda Automotive. They have also had another venture before called Mullen Motorcars, and it developed cars like Mullen GT, which was one of the world's earliest EV supercars. Overall, it's convincing to say that Mullen has been a veteran in the field and that it's been around for a long time with a track record that's long enough for us to see that they're not here as a marketing scam or they're not here just because it's become popular. But the real question is whether they have the means to stay in the game and if they fit the profile, if you will, for us to invest in the company and not just trade its stock. The sector has been known to be highly capital intensive and relying on other industries that may not be fully mature at this current point in time. There are also other long-term challenges ahead, such as keeping the valuation multiplier the same or maybe higher compared to what it is now, or avoiding the classification of a car or industrial operators, which will separate them from a tech company. So the recent price action has seen Mullen share price dip as low as 26 cents before recovering some of these losses back. Overall, Mullen has been down by more than 40% compared to the peak in the stock over the past few months. The price movement seems to be influenced by the market mood in general, not just towards Mullen itself. The recent news has been positive to Mullen, which explains the fact that the news will not be able to stop an ongoing trend, but might be able to slow it down or to confirm a burgeoning tendencies. Mullen fell as low as 26 cents and right now it is very encouraging to see it going back to around 31 to 33 cents, currently maintaining itself at least above 30. So the short-term price action shows us that the shares are slowing down in the recent sell-off phase and that the same force has pushed it upward, has now decided to regroup a bit and may decide to keep pushing it further up. Regarding the long-term price actions, despite the recent upward momentums, the company has been having a mostly difficult and bearish trend over the past 5 years, having traded between $5 and $10 for years before peaking around $15 and now falling back to the penny stock levels. What this tells us is that Mullen has been hard hit by ongoing stock market downfalls, and it has its own fundamental weaknesses, which certainly didn't help. This assessment has recently begun to change, but in my opinion, it hasn't reached a convincing level just yet. And that to a point still explains why Mullen as a company is a stock that I wouldn't really recommend to invest at the moment, regardless of the recent distribution contract that they got or the potential short squeeze. The interest surrounding Mullen is the expectation to get quick gains in a matter of weeks from the short squeeze, not necessarily yielding dividends from the car sales in the years to come. Now, with that being said, I also want to add that things can always move very quickly in this field, and that the idea of investing in Mullen shouldn't be completely ruled out, depending on how well they're gonna turn up to be in the upcoming month. So the online communities, along with media outlets, have been generally skeptical of how Mullen can do and its capacity to turn the company profitable. Some people have also been relatively uncomfortable with the periodic lack of transparency, like not disclosing key commercial partners and clients when they promised that they would do so. Of course, there remains a pocket of resolute optimists who believe that whatever happens to Mullen is always going to be a good news. If it goes up, it's going to give more gains, but if it goes down, it's going to give opportunities to place in more trades. In recent days, the promises given by the CEO have, I believe, rekindled some of the optimism, not just from like a small group of fans, but it managed to turn the public discourse in its favor, at least relatively speaking. So overall, Mullen is commented online mostly because it's a volatile stock, because people think that, the narrative is a good one. It's not always because of the fundamentals that it has, because in that sense, the company is actually relatively weak compared to the other players in the field. So regarding the macroeconomic trends, it's challenging for sure. The EV sector as a whole has been under pressure, both because the quantitative tightening caused by the interest rates hikes, the capital flights from riskier areas of the financial sector back into other options, the conflicts around the world, and also the bearish expectation of a long-due recession that's coming our way. So the additional concerns specific to the EV sectors include the supply chain issues and the shortages of key components. We also have to talk about the possibility that eventually mentality about EV companies is going to change. For example, it has already changed for many tech companies. Before, we just said, well, as long as they grow, things are good. Nowadays, it's no longer enough to grow. Investors also seem to want to see profits and hard-earned cash from their investments. So if that becomes the case, then first of all, the market cap of companies like Mullen, but also like Tesla, NIO, Lucid, it might go to another direction. And second of all, if they have to make a profit, then it would mean that they can no longer afford to grow their market share by spending more. So these are the things that we have to watch out for. Sometimes investors may value what is good or bad differently, depending on which era we are in. One final thing to consider, which is the element called Tesla. So a lot of what EV sector does relies on the performance and the value that investors give to the biggest company in the field, which is certainly Tesla. Recently, things haven't looked very well on that side, and to some extent, it may also affect the upward momentum and potential for companies like Mullen. Of course, this is only to a certain extent, because as far as the fundamentals go, it's not always a determining factor. I think that Mullen is not at that stage yet, where we can say, okay, things have settled down, and we can evaluate how the company does based on more objective data. We're not there yet. So when we look at the company's financials, it kind of confirms what I've been saying earlier, which means this is a company that will have some hurdles ahead of it. First of all, the cash balance. It has increased on a year-to-year basis, but this is probably just because they've been diluting the shareholders. It decreased from 105 million to around 84 million. And this is, although not a big issue, we know that it's only going to dip further as long as it doesn't have net positive operating cash flows. In other words, can its business bring new money in instead of just keep selling the company's shares? The other thing is the liabilities. They have already removed millions of liabilities, which I do believe that is a very good sign, because less liabilities means they have less like bankruptcy or solvency risks. Now, I don't think that the market really reacted to this news because their announcement that they have reduced the liabilities also coincided with when their stock price went down from like 55 all the way down to 26. Now, the profitability. This is also like a big weak point for Mullen. Hopefully, things are going to start to pick up now that they have the iGo distribution contract in Europe. But right now, they have no revenue, and they didn't have any revenue ever since the beginning of 2021. On the other hand, they have been increasing the research and development expense significantly. The general expenses is either down or stable. So this is overall a hopeful or a good sign even. But the operating losses are not helping, and they're gonna keep digging holes into the company's balance sheet until the company either will turn the situation around and be like, we can now make money, we can now be profitable, or they're gonna keep diluting the shareholders. Now, we have to remember one thing. Even though we can always say that, around 2020, Tesla went up because there was more demand, there still needed to be like an actual reason why they went up. So they went up because, frankly, they announced that they became a profitable company. So this kind of announcement is very significant for any sort of company, let alone and even more so for the EV companies. But so overall, the financials of Mullen shows us that they're trying to do well, that they're trying to stay afloat, but there are things that are outside of their control. Like, for example, they cannot really control whether they will have to dilute in the future. This is almost a certainty unless the company can turn the situation around and somehow start generating cash. Otherwise, they may face, delisting or solvency issues down the road. Like, for example, if they keep diluting the shareholders, at some point it's going to go below $1. And by then, NASDAQ would have to delist them if the situation persists for a number of months. Now, regarding the shareholder description, I would say that they're mostly retail, they're volatile, and they react quickly to price action movements, which means that Mullen is a good stock to trade. There are some institutional shareholders, and their number is increasing, but it's still not significant enough, in my view, to change my assessment that Mullen is a good stock to trade. It's not always a good stock for long-term holding. Of course, one other major catalyst for Mullen is the significant size of the short positions currently open and that haven't been redeemed yet. This is a very attractive situation for such a stock because the short position means that, they are positions that can make money while the stock is down, which is a very cherished functionality for some of the market participants. On the other hand, short selling also has the inconvenience of incurring financial fees as long as those positions are open because they're technically borrowed shares. And they have to be dealt with the fact that the potential losses when people short could be infinite. The short squeeze is a phenomenon consisting of a sudden demand to push the share price higher, which would then force the short positions to be redeemed in order to avoid further losses. Because keep in mind that, like we said earlier, these losses could potentially be infinite, and in the meantime, they're still incurring financial fees. With that being said, it's really important to control the exposure to a stock like this, regardless how interesting its narrative can be. Because at the end of the day, the opportunities will always be there, but the capital is limited. And at the same time, does it, like, do all these stars that are aligned mean that the short squeeze will certainly succeed? No, like nothing is for sure in this market. And on the other hand, the information that we currently have suggests that it's reasonable to believe that there could be like a probability that the stock will take off. So this is why it's worth our time to at least take a look at Mullen, ask ourselves if the stock is for us, and then maybe place in a position. So the investor profile for Mullen would be people who are willing to take risks, who believe in the relevance of EV as a sector, who believe that what Mullen has announced is true and also significant for its long-term future and the future prosperity of the company. They have a diversified portfolio, and they also believe in the short squeeze potentials of Mullen. So if you correspond to all of these, or at least many of these, then I would say that Mullen is a stock for you to at least glance over. You don't necessarily have to buy it, but at least take a look at it and see if it deserves a place on your shortlist. And over the next couple of days, Mullen needs to demonstrate its capacity to not only keep it gained so far, but to eventually be able to continue to go above. And so far, it's been, a few days since Mullen has held its ground around 30 cents. It would be best if we get to see at least another few attempts from the trading volume and the demand showing us that an entry point now is not only good, but it's going to be one of the lower levels that it's going to reach over the next couple of days or weeks. For now, I would say that the current price can be a decent entry point for those who are risk tolerant. If you would prefer to wait for additional confirmation, then definitely keep an eye on Mullen around late November. The exposure should be around 0.5 to 1% of the portfolio. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.